Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss 4 very important updates that the RBI has brought. Okay, so the first one is regarding the first meeting of the Payments Regulatory Board. So it is very important for you to understand that what is this Payments Regulatory Board, which other board has been replaced by this Payments Regulatory Board, how many members are there, how many times the Payments Regulatory Board has to meet in a year, and all these details we will discuss in today's session. And we will discuss about the first meeting of the Payments Regulatory Board. Okay, so like there is the Monetary Policy Committee of the Reserve Bank of India. Similarly, there is the Payments Regulatory Board now of the Reserve Bank of India. So that we have to discuss. The second news article is regarding the discussion that we had earlier that 10 lakh the collateral-free loan limit has been increased from 10 lakh to 20 lakh. So this was announced by the RBI. Now the final guidelines have been brought by the RBI. Okay. So here you can understand that the banks, they will have to provide the collateral-free loans up to 20 lakh for the micro small enterprises. Now the final guidelines have been brought, so we will discuss it in detail, and there is also a scheme that's related to this article, so that also we will discuss. Then we will discuss about the RBI that has recognized FEDAI as an SRO for the authorized dealers. Okay, so we will discuss the brief idea about the SRO, as well as we will discuss the basic criteria that is required to become the SRO for the authorized dealers. Last article that we have to discuss is just the idea we need to have regarding the RBI talks from Paisa to policy. So this is the theme that you have to keep in mind. Now this theme is regarding what, and what was the first podcast that happened under this theme. So all of this we will be discussing. Okay, so these are the 4 articles that we are going to discuss in today's session, and let's start with today's session. But first of all, give me a thumbs up if I'm clearly audible and the screen is visible. Good morning to all of you. Welcome to the session. Thank you for joining the session, and let's start with today's session. Just give me a thumbs up if I'm clearly audible and the screen is visible and everything is going fine. Okay. So now before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So if you want to get the PDF of the session, you can get the PDF in the Telegram channel. Okay. So let's get started with the first article, that is the first meeting of Payments Regulatory Board. So the first meeting of the Payments Regulatory Board was held in Mumbai under the chairmanship of the RBI Governor, that is Shri Sanjay Manotra. It may be recalled that the PRB, that is the Payments Regulatory Board, it replaced the Board for Regulation and Supervision of Payment and Settlement System with effect from May 9, 2025. So basically this Payments Regulatory Board, it has replaced the earlier Board for Regulation and Supervision of Payment and Settlement System. So see, the Payment and Settlement System Act 2007, it provides the legal basis, it provides the statutory basis for the regulation and supervision of the payment system in India. Okay, the payments are happening through various means. You are using UPI, you are using IMPS. So there are various means for the payments. Now the Payment and Settlement System Act 2007, it provides the legal basis for the regulation and supervision of payment systems in India, and designates the Reserve Bank of India as the authority for the purpose of regulation and supervision of the payment and settlement system and all related matters. Now the Reserve Bank of India has to regulate so many of the different regulated entities, banks, NBFCs, credit information companies, and so and so. So the Reserve Bank of India now delegates the RBI exercising its powers and performing the functions and discharge of the duties under the payment and settlement system. It has a board, that is the Payments Regulatory Board. So basically the Payment and Settlement System Act, it provides the powers, it designates the Reserve Bank of India as the authority for regulating and for supervising the payment and settlement system. As the RBI has to regulate so many of the different entities, and the Reserve Bank of India is at the apex of the monetary system, so RBI delegates its powers or perform the functions and discharges the duties through the board, that is the Payment Regulatory Board, in regards to the payment and settlement system. So the Payment Regulatory Board under the Reserve Bank of India gets the power to regulate and supervises the payment and settlement system. So this is the idea. Okay. Now the first meeting of the Payment Regulatory Board was held in Mumbai under the chairmanship of the RBI Governor Shri Sanjay Manotra. Now the Payment Regulatory Board on May 9th, 2025 has replaced the Board for Regulation and Supervision of Payment and Settlement System. Now let's see that how many members are there in the Payment Regulatory Board, how many times it meets and such. Okay. So the Payment Regulatory Board has 6 members. 3 members are from the Reserve Bank of India, while the other 3 members are nominated by the Government of India. They are nominated by the Government of India. So the 3 members from RBI are the Governor of the Reserve Bank of India, that is also the chairperson of the Payment Regulatory Board. Okay, the Deputy Governor in charge of the Payment and Settlement Systems, Executive Director in charge of the Payment and Settlement Systems. So these are the 3 members. These are the 3 members that are from RBI in the Payment Regulatory Board. The other 3 members that are nominated by the Government of India are Secretary of the Department of Financial Services, Secretary of the Ministry of Electronics and Information Technology, and Srimati Aruna Sundarajan, IAS retired. Now the principal legal advisor of the RBI is a permanent invitee to the meetings of the Payment Regulatory Board. So this is the basic idea. I hope it is clear that there are 6 members in the Payment Regulatory Board. 3 members are from the Reserve Bank of India and 3 members are nominated by the Government of India. Out of the 3 members that are from the Reserve Bank of India, the RBI Governor is also the chairperson of the Payment Regulatory Board. So that is the idea. Okay. Now the members of the board to be nominated by the central government shall be nominated provided that no person shall be nominated if the person has completed the age of 70 years on the date of appointment as member. So basically the members of the board that is nominated by the central government shall not be nominated if a person has completed the age of 70 years on the date of appointment as member. If the person is the member of parliament or any state legislature, or if the person has been convicted of an offence which is punishable with an imprisonment for a term of 180 days or more. So this is the idea that the central government has to nominate 3 members, but the central government cannot nominate the members or the people basically that have completed the age of 70 years, or if they are the member of the parliament or state legislature, or they are convicted of the offence where they have the imprisonment for a term of 180 days. Okay, that is 180 days. So this is the idea. Now the member of the board that is nominated by the central government shall hold office. So these members that are nominated by the central government, they can hold the office for a period of 4 years. But they are ineligible for reappointment. Okay. So the members of the board that are nominated by the central government, they shall hold office for a period of 4 years and they shall not be eligible for re-nomination. That means they are ineligible or they are not eligible for re-nomination. Now the board shall ordinarily meet at least twice in a year. Remember this, that the board has to meet at least twice in a year, and each member, that means these 6 members, each member has 1 vote. Okay. Now the quorum, that means the minimum number of members that should be present in the meeting are 3 members. So at least out of the 6 members, 3 members should be present in the meeting, and out of the 3 members that are present in the meeting, 1 should be the chairperson. If the chairperson cannot be present in the meeting, then in spite of the chairperson, like in the absence of the chairperson, the deputy governor, who is the member of the board, should be present in the meeting. Okay. So the quorum, that means the minimum number of people that should be present in the meeting are 3 people. 3 members should be present and 1 of the members should be the chairperson, and in the absence of the chairperson, if the chairperson cannot be present in the meeting, then the deputy governor should be present. Okay. Now, and 1 member nominated by the central government should also be present. It's not like that the RBI members are coming together and they are doing the meeting. It's not like that. So out of the 6 members, 3 members should be present, should be at least present in the meeting. Okay. And 1 should be the chairperson, or in the absence of the chairperson, the deputy governor, and 1 should be the member, at least 1 should be the member of the member that is nominated by the central government. So this is the idea, that out of the 6 members, 3 members are nominated by the reserve, 3 members are from the RBI, and 3 members are nominated by the Government of India. For the meeting, at least 3 members should be present. one should be the chairperson, that should be present, or in the absence of the chairperson, the deputy governor should be present, and out of the 3 members, 1 member nominated by the government of India should be present. Okay, so this is the idea. Now, the meetings of the board shall be presided over by the chairperson, that is the RBI governor. In the absence of the chairperson, if the chairperson cannot be present, then in the absence of the chairperson, the deputy governor, who is the member of the board, will be presiding. The deputy governor will be presiding over the Payments Regulatory Board meeting. In the event of equality of votes, let's say that 6 members are present. All the 6 members are present and 3 members are saying yes, 3 members are saying no. So what decision should be taken? So the RBI governor, that is the chairperson of the Payments Regulatory Board, has a casting vote, has a second vote. Okay, so additional vote the chairperson has. In the absence of the chairperson, if the chairperson is not present in the meeting, let's say there are only 4 members that are present. There are only 4 members that are present. The chairperson is not present and another member is not present. In this case, let's say 2 members are saying yes to the decision, 2 members are saying no to the decision. The chairperson is not present. In the absence of the chairperson, the deputy governor has the additional vote or the casting vote. So this is the idea. Any confusion? Any confusion here? So this is the basic idea that we have discussed. The Payments Regulatory Board has 6 members, 3 members from the RBI, 3 members nominated by the government of India. The 3 members from the RBI are the governor, deputy governor and executive director. The executive director and the deputy governor, they are in charge of the payment and settlement system. Okay, the governor of the RBI is also the chairperson of the Payment Regulatory Board. Okay, and we have discussed that they have to meet, the board has to meet at least twice in a year, and the quorum, that means minimum number of members that should be present in the meeting are 3 members. Okay, they should be present in the meeting. 3 members at least should be present in the meeting, and the chairperson presides over the meeting. In the absence of the chairperson, the deputy governor presides over the meeting. Now, additional details. The board shall be assisted by the Department of Payment and Settlement System of the Reserve Bank of India, which shall report to the board. Okay, so the board shall be assisted by the Department of the Payment and Settlement System of the Reserve Bank of India. It has to report to the board. It has to report to the Payment Regulatory Board. Now, a member nominated by the central government would cease to hold office, shall cease to stop to hold office if he is absent himself without the permission of the chairperson from 3 consecutive meetings of the board. So if a member nominated by the central government is not present for 3 consecutive meetings without the permission of the chairperson, then the member will stop holding the office. Okay, will stop holding its position as a member of the Payment Regulatory Board. So this is the idea. Now, coming to the first meeting of PRB, now we have discussed about the Payments Regulatory Board. I hope this is clear. The Payments Regulatory Board we have discussed. Okay, and the Payment and Settlement System Act 2007, it provides the power to the Reserve Bank of India for regulating and supervising the payment and settlement system in India. Now, the Reserve Bank of India delegates its powers or delegates its functions to the Payment Regulatory Board. That has 6 members, okay, that we have discussed. Now, the Payment Regulatory Board held its first meeting, and the board reviewed the functions of the Department of Payment and Settlement System. As we have discussed that the Department of Payment and Settlement System, it report to the board. So basically the board has reviewed the functions of the Department of Payment and Settlement System and current focus areas covering both the domestic and global payment system. As well as there was the discussion regarding the Draft Payment Vision 2028. So the Draft Payment Vision 2028 was presented in front of the Payments Regulatory Board, and the members of the Payments Regulatory Board, they gave strategic guidance to ensure the continued development of India's payment ecosystem. So you can understand that this is a very important draft that has been presented, and if the final directions are released, if the final Payments Vision 2028 is released, this will be very, very important from your RBI Grade B point of view. Okay. So right now the draft has been presented in front of the Payments Regulatory Board, but when the final comes, you have to cover that. Okay, so the Draft Payment Vision 2028 was presented, and members gave strategic guidance to ensure the continued development of India's payment ecosystem. A presentation on the major findings of the survey on digital payments recently conducted by the RBI was also made. So basic discussion happened, but the important point is that the draft has been presented for the payment vision 2028. When the final guidelines come, you have to cover it thoroughly. Okay, so this is the idea about the Payments Regulatory Board and the first meeting. Now moving forward with the next article. Any confusion, anyone? So the next article is regarding Lending to Micro, Small and Medium Enterprises Sector Amendment Directions 2026. So banks are mandated. See, in the statement on developmental and regulatory policy document that was released in Feb 2026 with the monetary policy statement of 2026 of Feb 2026. So with that, in the statement on developmental and regulatory policy document, it was stated that the collateral free loans limit for the micro and small enterprises will be increased from 10 lakh to 20 lakh from April 1, 2026. So basically it was said that from April 1, 2026, all the banks, they are mandated to provide the collateral free loans. They have to provide the collateral free loans up to the limit of 20 lakh to the micro small enterprises. Okay, before they were providing the collateral free loans up to the limit of 10 lakh rupees. Now the limit has been increased to 20 lakh rupees so that the micro and small enterprises, they can receive easier access to the credit. Okay, so for easier access of credit and the institutional credit to be provided to the micro and small enterprises, basically this collateral free loan limit is provided. So this is the idea. Now the banks are mandated not to accept the collateral security in the case of loans up to 20 lakh extended to the micro and small enterprises. So this is the idea that the banks are mandated that they cannot accept the collateral. They should not accept the collateral security in case of loans up to 20 lakh that is given to the micro and small enterprises. Banks are also advised to extend the collateral free loans up to 20 lakh rupees to all units that are financed under the Prime Minister Employment Generation Program administered by Khadi and Village Industries Commission. Okay, so this is the basic idea that the loans that are provided to the micro and small enterprises up to the limit of 20 lakhs will be collateral free loans, as the micro and small enterprises, they are very small enterprises. Okay, they do not have generational wealth or something. They are not from generational business or something. Okay, so micro and small enterprises are very small micro enterprises and they might not have enough of the collateral to take the loans from the banks, or they might not have the asset to give as collateral to take the loan. So that's why for the micro and small enterprises, 20 lakh rupees is the collateral free loan limit that has been decided. So up till this limit, no collateral is required by the by the micro small enterprises. Okay. Now the banks may, on the basis of good track record and financial position of the micro and small enterprise units, increase the limit to provide the collateral free loans up to 25 lakh. So basically 20 lakh is the minimum limit, that at least up to 20 lakh, there should be no collateral that should be taken from the micro and small enterprises. Okay, but it has been said that the banks, if they want, on the basis of the good track record and financial provision of the micro and small enterprises, if the bank wants, on the basis of its internal policy, the bank can provide the collateral free loans. Up to 25 lakhs. Okay, as per the internal policy. Now, however, see, it has been stated that if the micro and small enterprises, let's say there is a XYZ micro enterprise that wants to take 10 lakh rupees as loan or 15 lakh rupees as loan. So this should be collateral free loan, right? This should be collateral free loan and the bank has to provide the collateral free loan to the micro enterprise. But let's say that the micro enterprise voluntarily wants to give gold or silver as collateral so that the bank can reduce the interest rate, because you can understand that if the bank is giving the collateral free loan, then this collateral free loan is more risky for the bank. So the bank might be charging higher interest rate also. That cannot be stopped, right? The bank might be charging a slightly higher interest rate. So the micro small enterprise can voluntarily, if the micro and small enterprise wants, it can voluntarily give gold and silver as collateral, and the bank seeing that okay, the gold and silver is being received as a collateral, so that means there is less risk for the bank, so the bank can have easier terms and conditions for the micro and small enterprise. So this is the basic idea, that it has been said that accepting gold and silver as collateral that is given voluntarily by the micro and small enterprise by the borrower for loans sanctioned by the banks up to the collateral free limit will not be under the violation. So basically, micro and small enterprises can voluntarily give gold or silver as the collateral to the banks for taking the loan, and at the easier terms and condition at the lesser interest rate. So the banks are allowed to take such kind of collateral, only gold and silver collateral. Okay, so accepting gold and silver as collateral pledged voluntarily is the key term. So MSEs should give voluntarily the gold and silver, the banks cannot mandate it. Okay, so this is the idea. Now coming to the last point, that is the banks may avail the benefit of credit guarantee scheme cover. What is this credit guarantee scheme? Have you ever heard about the credit guarantee scheme? So basically, credit guarantee fund scheme for micro and small enterprises, it was launched in August 2000. Okay, the nodal ministry is Ministry of Micro, Small and Medium Enterprises, and the implementing agency is the Credit Guarantee Fund Trust for Micro and Small Enterprises that was established by Ministry of Micro, Small and Medium Enterprises and FEDAI. So basically, the Ministry of MSMEs and FEDAI, they established the Credit Guarantee Fund Trust for micro and small enterprise. Okay, for micro and small enterprise. Now, under this is the implementing agency that implements the credit guarantee fund scheme for micro and small enterprises. So this is the basic idea, that the credit guarantee fund scheme for micro and small enterprises, this was launched in August 2000, and the nodal ministry is Ministry of MSME. The implementing agency is the Credit Guarantee Fund Trust for Micro and Small Enterprises, and it was established by the Ministry of MSME and FEDAI. So FEDAI and the Ministry of MSME, they both have the role in the Credit Guarantee Fund scheme for micro and small enterprises. Now, why this scheme was launched? What is the requirement of the scheme? You can understand that credit guarantee. So under this scheme, basically, you can understand that the micro and small enterprises, they are getting collateral free loan. So it is very risky for the banks, because the banks are giving the 20 lakh rupees, let's say, as collateral free loan, but the bank does not have any backing. This is a risky loan. What if the money is not returned by the micro and small enterprise? What if the micro and small enterprise fails or closes down or goes bankrupt? Then who is going to return the money to the bank? Because bank literally have no collateral to reduce its risk. So in this kind of case, the credit guarantee fund scheme helps, where the scheme provides the guarantee, where under the scheme there is the guarantee that is provided to the bank, that if the micro and small enterprise fails, then 85% of the loans or 85% of your lending will be covered by the scheme, or 75% of your lending will be covered by the scheme. So that means there will be lesser risk that the banks will have to face. Okay, so this is the idea, that the aim of this scheme is to make available the collateral free loan to the micro and small enterprises by providing credit guarantee to the banks, by providing the credit guarantee to the member lending institutions. Okay, so this is the basic idea. I hope this is very much clear to all of you. Yes, recently in the budget, there was the discussion for the credit guarantee fund scheme for the startups and credit guarantee fund scheme for the exporters also. So this credit guarantee scheme is very important. Okay, and there is the discussion regarding the micro and small enterprises also. So the credit guarantee fund scheme for micro and small enterprises, the aim is to make the collateral free loans accessible to the micro and small enterprises from the banks, so that institutional credit can be provided to the micro and small enterprises. The micro and small enterprises should not be dependent on the money lenders, on the non-institutional sources for the loans. Okay, so micro and small enterprises should be dependent on institutional credit from the banks, from the NBFCs, rather than depending on the non-institutional sources like the money lenders that charge exuberant interest rates. Not high, they charge exuberant interest rates that are very, very high. So micro and small enterprises, so that they can get the loans from the institutional credit facilities from the banks, so that there is the credit, so that there is the collateral-free loan facility that is provided for the micro and small enterprises, and the guarantee for these loans till a limit, the guarantee is provided through this scheme. Okay, so here is the chart in front of you. This is taken directly from the website, but the data can change, so keep following the percentages. Okay, right now this is the latest data, but it can change. Okay, so here you can see that maximum extent of guarantee coverage. So basically guarantee is provided to the banks, guarantee is provided to the NBFCs, guarantee is provided to the member lending institutions. To the member lending institutions, the guarantee is provided, so that the member lending institutions like the banks, they provide the collateral free loans to the micro small enterprises with less of the fear. Okay, so this is the idea that micro enterprises, the smallest of the enterprises, the micro enterprises, if they are taking the loan up to 5 lakh, then the guarantee is 85%. If they are taking loan above 5 lakh and up to 50 lakh, the guarantee is 75% from the scheme, through the scheme. Okay, so micro small enterprises located in northeast region, union territories of Jammu and Kashmir, union territory of Ladakh, so they get the guarantee of 80% of the loan. So you can understand that the banks are less worried now, because they will get 80% of their loan back even if the micro and small enterprise fail and does not return the money. Okay, so this is the idea of the credit guarantee fund scheme, that guarantees the collateral free loans, that guarantees the loans that is provided to the micro and small enterprises to an extent. Okay, as well as it has been said by the Reserve Bank of India that the extent of guarantee coverage for micro and small enterprises situated in identified credit deficient districts. So basically there are certain districts in the country that are credit deficient, that does not have accessible credit easily. Okay, see, these are the credit deficient, districts. So the identified credit deficient districts, basically the extent of guarantee coverage for the micro and small enterprises that are situated in identified credit deficient districts by RBI is additional 5% over and above the applicable guarantee coverage. So whatever is the applicable guarantee coverage, the RBI will provide 5% extra. 5% extra will be provided, 5% extra guarantee will be provided. That means if 75% is the guarantee coverage under the scheme, 5% extra, that is 80%. 80% will be provided if the loan is given to the micro and small enterprise that is situated in identified credit deficient district that is identified by RBI. This is the idea. Okay, so under the scheme, basically under the scheme, if the guarantee is provided or if the loan is provided, so under the scheme, basically if a bank is providing a loan to a micro and small enterprise that is situated in the identified credit deficient district that is identified by the RBI, that is, this is the identified credit deficient district identified by the RBI. So the RBI has said, or the government has said, that additional 5% of the coverage will be provided, okay, by the scheme, by the government and SIDBI. So this is the idea. I hope this is clear. 15% is what? The rest of the 15% you are saying, that will be the risk the bank takes now, because even if the bank is taking the collateral, the bank might not be able to cover the whole of the cost of the loan. Okay, so the 85% is the guarantee of the scheme, or the guarantee provided by the scheme, and the rest is the loss for the bank, and the bank usually take the risk. This much is the risk that the bank can handle. Okay, chalo. So I hope this is very much clear. We have discussed the basic idea about the credit guarantee fund scheme for micro and small enterprises, and we have discussed that in the identified credit deficient districts that are identified by the RBI, there is additional 5% over and above. There is additional 5% of the coverage, guarantee coverage, over and above the applicable guarantee coverage under this scheme, under this scheme. Okay, now coming to the recognition of FEDAI as SRO for authorized dealers. First of all, what are the authorized dealers? Authorized dealers are the banks or the financial institutions that are authorized, that are permitted to undertake the foreign exchange transactions. Okay, so basically the banks and the financial institutions, authorized dealers are the banks or financial institutions that are authorized, that are permitted to undertake the foreign exchange transactions. Okay, they can buy or they can sell the foreign exchange. They can buy and sell the foreign exchange. So basically authorized dealers are the intermediaries that can buy the foreign exchange from the RBI, they can buy the foreign exchange from the customers, and they can sell the foreign exchange to the customers and such. So authorized dealers are the banks or the other financial institutions. They are the entities that are allowed to undertake the foreign exchange transactions. They can buy and sell. They are the authorized dealers that can buy and sell the foreign exchange. Okay, so this is the idea. So if you want to get dollars to travel to US, or if you want to get euro to travel to Europe, so you can go to a bank or you can go to a full-fledged money changer that are the authorized dealers. They are the ones that can provide you the dollars or euros against your rupees. So banks, for full-fledged money changers and the other financial institutions, they are the authorized dealers or the authorized persons that are authorized to transact in the foreign exchange. They are authorized to transact in the foreign exchange by the RBI. They are authorized by the RBI to transact in the foreign exchange. Now, the Foreign Exchange Dealers Association of India, FEDAI, has submitted an application under the Omnibus Framework for recognition of SRO for regulated entities of RBI. So first of all, what is this Omnibus Framework? So actually, this framework was issued by Department of Regulation of the Reserve Bank of India on March 21st, 2024. This is the Omnibus, that is one framework, one inclusive framework for recognizing the self-regulatory organization for different regulated entities of the RBI. Try to understand that the RBI regulates various categories of banks: scheduled commercial banks, cooperative banks, regional rural banks, and such. The RBI also regulates the various categories of NBFCs, investment and credit companies, or there are the different NBFCs, the peer-to-peer lending, or there is the NBFC account aggregators. So there are various categories of NBFCs that are regulated by the Reserve Bank of India. Then the credit information companies, the payment system operators. So there are various regulated entities that are regulated by the Reserve Bank of India. There are some fintechs also that are regulated by the Reserve Bank of India. Now, as so many of the regulated entities are regulated by the Reserve Bank of India, does the Reserve Bank of India have the power or the people to look after each and every bank, each and every NBFC, each and every credit information company, that okay, this particular credit information company, this particular NBFC, is it facing any problem? This particular fintech, is it facing any problem? So RBI does not have that much power capacity, right, to look after each and every bank or to look after each and every NBFC and the payment system operators or the payment system providers and such. So basically SRO, that is the self-regulatory organization. Let's say there is the SRO for NBFCs. Okay, there is the SRO for fintech. So the SRO, they are the self-regulatory organization. They work as a bridge between a category of the regulated entity and the Reserve Bank of India, so that if this regulated entity, if these regulated entities are facing any problem, the SRO is the one that can share it with the RBI. If the RBI is releasing any guidelines that are difficult to understand for the regulated entity, for this particular segment of the regulated entity, then the SRO can make the compliance easier, as the SRO will help the regulated entities to understand the guidelines. So basically SRO is working as a bridge between the regulated entities and RBI, because RBI has to regulate so many of the regulated entities that RBI cannot individually look after each one of them. So SRO will act as a bridge between the particular category of regulated entities, maybe SRO NBFCs, there is SRO fintech. So a particular SRO will look after a category of the regulated entities and will share the problems with the RBI and such. So this is the idea, okay? So SRO, they act as a bridge. They connect the regulated entities or a particular category of regulated entities and the Reserve Bank of India effectively. So the SRO, they ensure compliance, so that if RBI is releasing any guidelines, so SRO for NBFCs, let's say, they look after that the NBFCs, they are following the guidelines, okay, uphold regulatory guidelines and standards. They develop the sector, they foster growth, they foster fair competition and advancement within the industry. They protect the interest of their own category, also safeguard the rights and well-being of the stakeholders. So if the SRO NBFC is there, so it will share the problems that is faced by the NBFC with the RBI, so that there is the interest of the NBFCs that is also protected. Foster innovation, they encourage new ideas and solutions in a environment that does not lead to detriment of the customers, okay, that does not lead to the problems for the customers. So innovation is fostered in a protected environment so that the customers are not affected. Detect signals, identify and address the potential risk, and they act as a bridge between the category of the regulated entity and the Reserve Bank of India. Now, the omnibus framework, that is the one inclusive framework, was released for recognizing different SROs for the different categories, for the NBFCs, for the authorized dealers, for the fintech and such. So a omnibus framework was released for recognizing SRO for the regulated entities of the Reserve Bank of India. Now there are certain fintechs that are not regulated by the Reserve Bank of India. Okay, there are fintechs, financial technology companies, that are not regulated by the RBI. So that's why for the SRO, for fintech, there are separate guidelines that were released, okay, but this omnibus framework, this was for the recognition of SRO for the regulated entities, for the banks, NBFCs, authorized dealers that are completely regulated by the Reserve Bank of India. For the SRO fintech, there are separate guidelines, okay. Now coming back to the topic at hand, FEDAI has submitted an application under the omnibus framework, under this framework, because this is the framework to be recognized as a SRO for the regulated entity, for a particular category of regulated entity under the Reserve Bank of India. Now what has happened, that after examining the application that was sent by FEDAI to become a self-regulatory organization, considering the fact that FEDAI has been functioning similar to the self-regulatory organization through its rules governing the conduct of its members, and it has been decided to recognize FEDAI as an SRO for all the authorized dealers that are regulated by the Reserve Bank of India. Okay, so this is the basic idea, that authorized dealers, they are authorized by the Reserve Bank of India to transact in the foreign exchange. Now all these authorized dealers, like FEDAI has become the SRO for all the authorized dealers. It is not mandatory for the authorized dealers to join this FEDAI, because it is voluntary situation. Authorized dealers, if they want to join the FEDAI, they can join the FEDAI. Okay, so FEDAI has become the SRO, the self-regulatory organization for all the authorized dealers. Now FEDAI has been given 1 year to bring its functioning and governance framework in line with the omnibus framework and take necessary steps to extend its membership to all categories of authorized dealers, because there are 3 categories of authorized dealers: authorized dealer 1, authorized dealer 2, authorized dealer 3. Okay, so that is the idea. So FEDAI has been given 1 year to start to bring its functioning and governance framework in line with the omnibus framework. The responsibilities, objectives have been laid down in the omnibus framework, so the FEDAI has to work according to that, and FEDAI also has to take the necessary steps to extend its membership to all the authorized dealers. Now it is on the authorized dealers that they want to join the FEDAI or not, but usually the authorized dealers can join the FEDAI. They just have to provide a membership fee and they can join the FEDAI, and you can understand that the FEDAI will act as a bridge between the RBI and the authorized dealers. Okay, now the applicant, so FEDAI has become the SRO for the authorized dealers under the omnibus framework. So what was the basic requirement? So basically the applicant, that was FEDAI, it shall be set up as a not-for-profit company registered under Section 8 of Companies Act 2013. So the entity that wants to become the SRO should be a not-for-profit company, and the shareholding of the SRO or the shareholding of the entity that wants to become the SRO should be sufficiently diversified, and no single entity in singly or in concert should hold 10% or more of its paid up share capital. So no entity, either single-handedly or in concert or in group, no entity shall hold 10% or more of its paid up share capital. Okay, so this is the idea, that the SRO should be a profit company set up as the Section 8 company. Okay, it should have diversified shareholding that should ensure that no single entity on the single-handed basis or on the group should hold 10% or more. Okay, as well as the minimum membership. Simply, if the FEDAI has only one authorized dealer, so can it become the SRO for the authorized dealers, for all the authorized dealers? No. Basically, FEDAI needs to have the minimum membership that may be prescribed by the Reserve Bank. This shall be attained ideally at the time of making the application. So FEDAI already has been functioning similar to the SRO, and it has already a lot of members that has joined the FEDAI, because FEDAI was working for the benefit of the sector, for the benefit of the authorized dealers. Okay, so now the FEDAI has to keep in mind that it needs to get the minimum membership, and within 2 years it needs to have the minimum membership. It needs to have some minimum members within itself. So that's the idea. Now, coming to the last article for today, I hope everything is clear. First, we have discussed about the first meeting of the Payment Regulatory Board. Okay, so we have discussed about the first meeting of the Payments Regulatory Board. We have discussed about the Payments Regulatory Board. Then we discussed about the lending to the micro and small enterprises. 20 lakh is the new limit now, and the banks, according to their internal policy, can provide the collateral-free loans up to 25 lakh also, as well as there is the guarantee that can be provided through the scheme, that is the credit guarantee scheme. Okay, so the banks can take the benefit of the guarantee provided under the credit guarantee scheme. Then we discussed the recent FEDAI that has become the SRO for the authorized dealers. Okay, so this is also what we have discussed. Now the last article is the easiest one, RBI's official podcast, RBI Talks, Paisa to Policy. Now it is important for the phase 1. Now this particular article is important from the phase 1 perspective, not so much for the phase 2. So remember that the earlier articles, they were important for phase 1, for phase 2, but this particular article, it is more important from phase 1 perspective. Okay, because directly it can be asked that the RBI's official podcast, what is the theme for that, what is the name for that? Okay, like in the phase 1 in 2024, there was a question regarding Miss Money and Mr. Money and such. Okay, so in the monetary policy statement dated December 2024, the Reserve Bank had announced its proposal to add podcast to its communication toolkit for wider dissemination of information of interest to the general public, so that the information can be shared to the general public through these podcasts. Okay, now the RBI's podcast series aims to simplify the complex financial topics and make financial knowledge more accessible and inclusive. Okay, so accordingly, the Reserve Bank has launched its podcast series, that is RBI Talks, Paisa to Policy, and with the first episode titled Demystifying the Know Your Customer. Okay, so this is the basic idea. RBI has launched its official podcast, that is RBI Talks, Paisa to Policy, and you have to remember the name, as well as the first episode of the podcast was titled Demystifying KYC. So of course the discussion happened regarding the Know Your Customer guidelines and the Know Your Customer requirement and importance. So this is the idea. This is it for today, and these are the questions in front of you. The first question is regarding the Payments Regulatory Board. I hope now you know the members in the Payment Regulatory Board, how many times do they have to meet, as well as how many minimum number of members that should be present, who has the casting or second vote. So the chairperson of the Payment Regulatory Board has the second or casting vote, has the additional vote. In case of equality of votes, the chairperson has the additional vote, but in the absence of the chairperson, the deputy governor, member of the board, has the additional vote or the casting vote if the chairperson is absent. So all of this we have discussed. So this is the first question in front of you. Try to answer this question. Now the second question in front of you is very easy. What is the name of the podcast series that has been launched by the Reserve Bank of India? So this is a direct question that can come in the phase 1. Okay, so try to answer this question. Now the last question in front of you is that the SRO for authorized dealer has been recognized. What is the name, or which entity, which organization has been recognized by the RBI as an SRO for the authorized dealer in foreign exchange? Try to answer this question. Okay, and remember that if the full forms are not given, so you might be confused. So remember the term very clearly, that who is the SRO for the authorized dealer. So this is it for today. Thank you everyone. Thank you for joining. I hope you will be easily able to answer the 3 questions. Do write the correct answers in the comment section below, and I will comment below whoever has given the correct answers within 24 hours. So I will comment down below. Okay, so this is it. Any confusion, anyone? Sorry, I was not feeling well today, so I hope I was able to clearly explain the things to you. If there is any confusion, any problem, any part that you were not able to understand, then that you can comment down below, okay? I will try to explain in the comments then. Okay, then thank you everyone. Thank you for joining. See you in the next session.